All right, let's talk about one of the toughest, most important decisions any real estate investor has to make. When do you hold on to a property, and when is it really time to sell? Look, this isn't just about a gut feeling. It's a strategic process, and getting it right is what separates the pros from everyone else. So let's dive into how you can make these calls with total confidence.
So you've got this great property, right? Maybe you've put blood, sweat, and tears into it. But is it a lifelong commitment? You know, it's so easy to fall in love with an asset, to get emotionally attached. But professional portfolio management, it's not about emotion. It's about a cold, hard, systematic approach to getting the best possible returns.
And really, it all boils down to this one single, vital question. This is it. This is the core framework that should guide every single decision you make. You have to forget about the history, forget about how you feel about the building. The only thing that matters is this. Is your capital working as hard as it possibly can in this asset right now?
That question, that's the absolute foundation of our entire strategic playbook today. Answering it is what turns you from a passive owner into an active, sharp-witted portfolio manager.
So how do you actually answer that big question? Well, not with a guess, but with data. So coming up next, we're going to open up the toolbox. We're going to equip you with a 4-part analysis toolkit that gives you the essential lenses to evaluate any property. These are your 4 pillars. Think of them as 4 different lenses you got to look through. First, how is the asset doing right this second? Second, what can we realistically expect down the road? Third, what's happening in the broader market? And finally, what's it going to cost you to keep this thing running? You have to look through all 4 to get the full, unbiased picture.
Okay, looking through that first lens, one of the most critical numbers is your cash-on-cash return. Now, the magic here, the thing a lot of people miss, is the denominator current equity. We're not talking about what you paid for it years ago. We're talking about the capital you have tied up in the deal at today's value. This tells you exactly how hard that capital is sweating for you. It's a real-time health check.
Next, you've got to pull out your crystal ball. It's not enough to know how it's done in the past. You need to model what happens if you keep holding it. And the key calculation here is what we call the marginal IRR. What's the extra return, the extra juice you're going to get for holding on for just one more year? If that number is lower than what you could get somewhere else, that's a huge red flag. And this leads us right to the third lens, market positioning. You have to ask, is this neighborhood growing? Is a brand new competing building going up across the street? Are your tenants in booming industries or dying ones? The asset might look great in a spreadsheet, but if the market around it is weakening, your future is in jeopardy.
And hey, what's it going to cost you to just hold on? Look, buildings get old, leases expire, and you have to pour cash into tenant improvements and commissions to get new ones. And don't even get me started on your debt. If you've got a loan coming due in a high-rate world, your whole financial picture could get flipped upside down overnight. All these future costs have to be part of the equation.
Okay, so you've done the heavy lifting. You've run the numbers using your toolkit. Now what? Well, Section 3 is all about interpreting that data. Your analysis will start to show you some really clear signals, pointing you one way or the other.
Let's start with the signals that might be screaming at you that it's time to move on. These can come from the market, the property itself, or even just your own portfolio strategy.
So what are some of these triggers telling you to sell? Well, first, is the market just on fire? Are buyers paying crazy high prices? That's an obvious one. Second, did you already do what you set out to do? If you've renovated, leased it up, and squeezed out all the value, maybe your job is done. Third, is there a massive capital expense looming on the horizon that you'd rather not deal with? Fourth, maybe you're just too concentrated in one city or one property type and it's time to diversify. And finally, hey, if you've already hit your home run, sometimes the smartest move is to just take your winnings off the table.
But of course, hitting the sell button isn't always the right play. Let's flip the coin. There are some really compelling reasons to stay put. Sometimes, the most profitable thing you can do is, well, nothing at all.
So when does holding make total sense? The signals here are just as clear. Is the property an absolute cash flow machine, just spitting out strong, stable returns month after month? Is there still runway to increase its income? Maybe you can push rents or cut costs. Do you have some amazing low-interest long-term debt locked in that you could never get today? Would a sale trigger a monster tax bill that you have no plan for? And finally, are you still getting great tax benefits from depreciation? Any one of these could be a massive green light to just keep holding on.
Of course, it's super important to remember that not all real estate is created equal, right? This hold versus sell math changes dramatically depending on the property type. For an office building today, this flight to quality and the whole work-from-home thing are enormous factors. But for an industrial warehouse, being a last-mile hub could make it unbelievably valuable. You have to apply this framework through the specific lens of your asset class.
Now for Section 4.
let's talk about the 7 common investor traps. Because even if you have the best spreadsheet in the world, your own brain can be your worst enemy when it comes to making a rational call.
Oh man, we've all seen these. Emotional attachment, that's when you hold on because it was your first deal, not because it's a good investment. Then there's the sunk cost fallacy. You keep throwing good money after bad just because you've already spent so much. And a huge one, analysis paralysis. That's when you wait for the absolute 100% perfect moment to sell, which, let's be honest, never actually comes. You miss the peak and sell on the way down. Avoiding these mental traps is every bit as important as getting the numbers right.
All right, that brings us to our final section, the ultimate litmus test. After all the number crunching, after considering every single angle, you can actually distill this whole thing down to one powerful, decisive question.
After everything, if you are still sitting on the fence, there is one final, clarifying little thought experiment that can cut through all the noise.
This is it. This is the whole ball game. If this property were for sale today, right now, at its current market price, would you write a check for it? If your honest-to-goodness answer is no, if you wouldn't use your fresh capital to buy your own asset, then that is the absolute clearest sell signal you will ever get.
And that leaves us with one final thought. Your assets, they aren't trophies in a museum to be collected and admired. They are business units, and each one has to justify its existence in your portfolio every single day. Manage them actively, question them relentlessly, and you'll build a portfolio that truly performs.